first question is, how often do your boards meet to review and discuss asset allocation? Could you walk us through that process?
Sure. I'll start. Brian Lewis, Chief Investment Officer for the State Employees Retirement System. So the PSERS asset allocation is reviewed every 2 years by our board. That process that takes place involves a combination of staff working with external consultants as well as with our actuaries to understand where we currently are from an asset perspective, but we also take into account the liabilities and the obligations that we're required to meet.
How have the targets, either the asset allocation targets, changed over the last, say, 3 to 5 years?
So again, for us at PSERS, the asset allocation targets have remained fairly similar over the last 5 years, and well beyond that, actually over the last 10 years. The changes that have taken place in our asset allocation have really been around the categorization or grouping of the types of investments, but our focus on return generation and growth assets has remained consistent over the last actually 10 years and beyond.
Same 2 questions for PSERS, please.
Sure. Our board will look at the asset allocation once a year, so formally in an August meeting normally. We'll go through sort of the same process that PSERS does. We will do an asset liability study, and that's normally done once every 3 years unless something's really changed. We'll go through the expected capital market assumptions, what we expect from the various asset classes, which we can choose from to invest in, and the board will set an asset allocation based on what it believes to be a return that we can get that equals 7.25 or more with the least amount of risk we can do so to do that. And over the past 3 to 5 years, I mean, the allocation hasn't materially moved over the past 3 to 5 years. It's a rather balanced allocation. So we try to balance our risk between equities, between fixed income, between real assets. You know, if you look at the past 10 years, there was a significant shift about 10 years ago where we really reduced the equity risk of the portfolio and looked to generate a more balanced portfolio, more balanced return stream over time that we thought would best suit the system.
When you encounter a December, such as the December of 2018, do your boards react to that and make any changes, or do you stick to it?
No, we would stick to it. I mean, the asset allocation is built for the long run. It's not built for quarter to quarter. I mean, there's a fear that you overreact to a situation, and we try not to. We want to build a portfolio that's durable over a long period of time.
Yep, and I agree with that. Thank you very much. Could we talk just for a minute about what I'll call alternative investments, or the non-traditional, not stocks, not bonds?
Sure.
What portion of your portfolios are made up by those? What are their characteristics?
Well, we have 15% in private equity. That would be considered an alternative. We have 10% in absolute return, which really represents more of the hedge fund book for us. About 10% in private real estate. That could be considered alternative. And about 10% in private credit. So those would be the ones where I would consider alternatives on our books.
So you purchase positions in bank loans? Is that
part of it? Part in private credit would include bank loans, would be part of that allocation. There's lots of other things, other corporate type debt that we would have in there as well.
Okay. I mean, I know what my opinion is. Do you think heading in that direction carries more risk?
Actually, no. I believe the direction we've gone actually carries a little bit less risk than you would see in a normal public, say, high-yield bond. I mean, a lot of the high-yield bonds today in the public spectrum don't have covenants tied to them. So you're essentially lending money to a company without covenants on if they miss a payment or things like that. Whereas in the private credit field, we're underwriting those loans, or our partners are underwriting those loans, and actually having specific covenants in that if they don't meet their obligations, there's specific remedies that we can take, including cramming down the equity and taking the company if we need to.
Same question for PSERS, please.
Sure. We have approximately 31% of our asset allocation in alternative or private assets. We are currently below our asset allocation target within those areas. And to address the question on risk, we believe, as well as
Mr. Lewis, if I could ask you to draw the mic a little closer to you.
Sure, absolutely. Again, so we have about 31% of our assets in what I'll call broadly alternatives, but what will make up what most people consider private investments. We agree with PSERS that has helped to reduce the risk in the portfolio, particularly in volatile markets. We saw the strongest performer in our portfolio in 2018 with the downturn in December within our private equity portfolio. Over the last 25 years, it has returned 13.9% to our portfolio versus a U.S. stock index of approximately 9.8% over the same time period with less volatility in pricing. So with that, we use alternatives to help balance out some of the ebbs and flows in the normal public market cycle.